US debt hits 39 trillion. What it means for your money, real estate and future. The US national debt crossed 39 billion and most people are underestimating what this means. This is not just a macroeconomic headline. It results into inflation, interest rates, real estate and long-term wealth. In this video, I'm going to break down how it impacts on each of these items and how you as smarter professionals should position yourself. 39 trillion, that's not just a number, it's a signal about where the US economy is headed, how money will behave over the next decade and who will benefit and who will fall behind. Because here is the reality, debt at this scale doesn't just sit in a balance sheet, it reshapes inflation, interest rates, asset prices and purchasing power. And the biggest mistake smart professionals make, they assume that this is a government problem. It's not. It's a personal wealth problem and a massive opportunity. In this video, we'll break down what 39 trillion in debt actually means and more importantly, how to position yourself on the right side of this shift. What does 39 trillion in debt actually mean? Let's simplify this. The US government has borrowed 39 trillion over time and continues to run deficits, meaning this number keeps growing. Now here is the key insight. The government does not pay off this debt the way individuals do. Instead, it manages through inflation, economic growth, monetary policy by managing interest rates. And historically, most consistent way the debt is managed is by inflation. And why? Inflation quietly reduces the value of the real debt. If you owe 1 million today, it's not the same 10 years from now when inflation runs 3 or 4%. So while headlines focus on the size of the debt, the real question is how will it be managed and who absorbs the impact? The hidden impact, inflation and purchasing power. When debt rises, one of the most likely long-term impacts is persistent inflation. Not necessarily hyperinflation, but structurally higher inflation than what we are used to. Here it is what it means. Your cash loses value over time. Your expenses don't keep pace. Your savings, if they are not invested in property, erode. But here is the flip side. Inflation is not just a risk, it's also a transfer of wealth from savers to asset holders, fixed income earners to leveraged investors. And this is where most people get it wrong. They try to protect their money by staying conservative, when in reality, strategy can quietly destroy purchasing power. Interest rates, the balancing act. Now let's talk about interest rates. High debt creates a dilemma for policymakers. If rates go too high, debt servicing costs explode. If the rates go too low, inflation accelerates. So what do we get? A managed environment where rates fluctuate, but structurally cannot stay high for extended periods. Why this matters? Mortgage rates may come down over time. Asset prices may rise as borrowing becomes cheaper again. We have experienced that. And buying becomes very difficult, which leads to a critical insight. Waiting for the perfect rate may cost more than acting strategically. Real estate, the silent beneficiary. This is where things get very interesting. In an environment of high debt and moderate inflation, hard assets tend to outperform debt. Debt becomes cheaper and assets rise over time. And that's the strategic advantage. Real estate sits right at the intersection of all three. Think about this. You lock in a mortgage today, inflation reduces the real cost of that debt, the asset itself appreciates over time. This is not accidental. This is financial design. And if this perspective is helping you, rethink how money actually works. Make sure to click and subscribe the button, because this is where strategy replaces noise. Winners versus losers in this environment. Let's make this very clear. In a high debt inflation driven economy, there are two distinct paths. Those who fall behind, holding large amount of cash, avoiding leverage entirely, waiting for certainty before acting, relying only on income growth, and those that move ahead, owning appreciating assets, using structured intentional leverage, positioning early instead of reacting late, thinking in real inflation adjusted terms. The difference is not intelligence, it's positioning. 39 trillion is not just a number, it's a directional signal. It tells you inflation is likely to remain a structural force. Interest rates will be actively managed and asset ownership will matter more than ever. And more importantly, the rules of wealth creation are shifting quietly but decisively. The question is no longer whether this impacts you. It already does. The real question is, are you positioned to benefit from it or absorb its consequences? Because in the next decade, the biggest divide will not be between those who earn more, but between those who understand how money works and those who don't. Thanks for watching. See you on my next one.